All right, let's talk about making big money decisions. I mean, the kind of multi-million dollar bets that can make or break a company. Today, we're going to build a toolkit that helps you turn those massive, risky ideas into smart, calculated investments. Let's jump right in. So, picture this. You're the one in the hot seat. You've got the power to greenlight a huge new project. Maybe a new factory, a new product line, something big. It's exciting, for sure. But it's also kind of terrifying, right? How do you go from just a gut feeling to being absolutely confident that this is the right move? I mean, that's the fundamental question, isn't it? When the stakes are that high, a simple guess just won't cut it. You need a system, a framework for really digging in and evaluating whether that million-dollar idea is going to pay off over its entire life. And that framework has a name. It's called capital budgeting. This is the pro-level method for analyzing those big, multi-year investments. And the key word here, the absolute bedrock of this whole thing, is cash flows. Now, it's so important to get this straight. We're not talking about accounting profit here. We're talking about actual, real cash in hand. Capital budgeting looks at the money literally coming in and going out. It includes things like loan payments, but ignores things that aren't cash, like depreciation. This focus on real money is what makes these tools so incredibly powerful.
Okay, so let's start with the most intuitive tool in our kit. It's the one everybody, and I mean everybody, instinctively asks first. How long until we get our money back? And that, my friends, is the payback period.
It is exactly what it sounds like. It's simple, it's fast, and it gives you a fantastic sense of how risky an investment might feel. You know, if you invest $1,000 and you're getting back $500 a year, your payback period is 2 years. Super easy, right? It's a great first glance. So, check this out. We've got 3 projects. All of them cost $1,000. Project C pays back in just 2 years. Project B takes a little under 3, and Project A is the slowest at 4 years. So just going by this one metric, Project C looks like the slam dunk winner. But here's the crucial question. If we only focus on how fast we get our money back, are we missing the bigger picture? Does getting that initial investment back quickly guarantee we've actually made the smartest choice for the long haul? And here's the punchline. When we look at the total cash each project brings in, the story completely flips. Project C, our so-called winner, actually generates the least amount of cash overall. And Project A, the one with the slowest payback, ends up generating a massive $2,500. This is the huge, glaring flaw of the payback period. It has tunnel vision. It completely ignores every single dollar that comes in after the initial investment is paid back. So, to fix this problem, we need to level up our thinking. We need to bring in one of the most fundamental ideas in all of finance. We have to talk about the time value of money. Put simply, a dollar in your pocket today is worth more than a dollar you're promised a year from now. Why? Because you can take that dollar today and invest it. You can make it work for you. And that potential to earn a return is what gives today's money its extra value. The way we do this is with a process called discounting. It's kind of like a financial time machine. We take all those cash flows from the future, year 1, year 2, year 5, and we pull them all back to today, to year 0, to figure out what they're really worth to us right now. Let's make this real. Looking back at Project B, that $350 in year 1, it's not actually worth $350 today. It's worth about $318. And that same $350 way out in year 5, it's worth even less today, only $217. So when you add it all up, the $1,750 in nominal cash is really only worth about $1,300 in today's money. Just let that sink in for a second. That $350 you're hoping to get 5 years from now has lost nearly 40% of its value by the time you translate it back to today. That one number shows you the incredible power that time and risk have over money. This brings us to what many consider the gold standard of capital budgeting, net present value, or NPV. And the beauty of it is its simplicity. You just take the present value of all the money coming in, subtract the present value of all the money going out, which is usually just your initial investment, and what's left is the NPV. And the rule is simple. If it's positive, the project creates value. You do it. If it's negative, it's destroying value. You walk away. Now, NPV is fantastic. It gives you a hard dollar amount of value created. But, sometimes people just want to know, what's my rate of return? They want to talk in percentages. And for that, we turn to our next set of tools. The internal rate of return, or IRR, is basically the project's own built-in rate of return. It's the break-even point. So if your IRR is, say, 15%, that means your project is earning a 15% return each year. You can then compare that to whatever your company's required return is and make a decision. But IRR has a hidden quirk. It's got this built-in assumption that all the cash the project spins off along the way can be reinvested at that very same high IRR. So if your project has an amazing 30% IRR, the formula just assumes you can go out and find other 30% investments to put that cash into. And let's be honest, that's not always realistic. And the fix for this is called the Modified Internal Rate of Return, or MIRR. It's basically the smarter, more practical cousin of IRR. It lets you plug in a separate, more realistic rate for reinvesting those cash flows, which gives you a much more accurate and, frankly, more defensible percentage return for your project. Okay, so we've covered a ton of ground. We have the payback period, net present value, IRR, the whole shebang. Now, let's put it all together and see how these tools work in a real head-to-head comparison. Let's build out our complete decision-making toolkit. And this is where it all comes together. This table shows us there's no single best project. It all depends on the question you ask. Project B creates way more absolute value with an NPV of over 274 grand. But wait, look at Project A's IRR. It's got a much higher percentage return. And then there's the profitability index, which answers the question, which project gives me the most bang for my buck? Here, Project A wins again, generating $1.26 in value for every single dollar we put in. It's way more efficient. So let's wrap this up. The payback period, that's for when you're a startup and cash is king. You just need to know how fast you're getting your money back. NPV, that's the go-to for a big company trying to maximize shareholder value above all else. The profitability index is perfect when you have a limited budget and need to pick the most efficient projects. And IRR, or MIR, they're perfect for when you need to communicate your return in a simple percentage that everyone understands. And that really is the ultimate lesson here. These methods aren't fighting each other. They work together. They're just different lenses to look at the same investment. True financial skill isn't about memorizing formulas. It's about understanding which question you need to ask and then picking the right tool for that specific job. So as we close out, I'll just leave you with this thought. Whether you're making a huge business decision, a career change, or even a personal investment, you now have the tools to look beyond just the surface. You can think about the cash flows, the timing, and the true value you're creating. Thanks so much for tuning in.